What is leverage, and how can it be used with caution? Understanding leverage. Leverage is a financial tool that allows traders and investors to control a large position in the market with a relatively small amount of capital. It is essentially borrowed money from a broker, enabling traders to amplify potential profits. For example, with a leverage ratio of 10 to 1, an investor can control $10,000 worth of assets with just $1,000 in their account. While leverage increases profit potential, it also significantly magnifies losses. This makes it a double-edged sword that must be used with caution. How leverage works. Leverage is expressed as a ratio, e.g., 5 to 1, 10 to 1, or 100 to 1. 1%, indicating how much capital is borrowed relative to the trader's own funds. In leverage trading, a margin account is required, where traders deposit a percentage of the total trade value, known as margin, while borrowing the rest from the broker. For instance, in Forex trading, a 50 to 1 leverage ratio means a trader only needs $200 to open a $10,000 trade. If the trade moves in the trader's favor, profits are significantly larger than if they were trading without leverage. However, if the trade moves against them, losses are also multiplied, potentially wiping out their entire capital. Risks of using leverage magnified losses. While leverage can boost profits, it can also lead to massive losses, sometimes exceeding the initial investment. Margin calls. If the market moves against a leveraged position, a trader may receive a margin call, requiring them to deposit more funds or risk liquidation. High volatility exposure. Markets can be unpredictable, and high leverage increases vulnerability to price swings. Psychological pressure. Trading with leverage can create stress and lead to emotional decision-making, which often results in poor risk management. How to use leverage. Safely. Use low leverage. Beginners should start with lower leverage, e.g., 5 to 1 or 10 to 1, to manage risks effectively. Set stop-loss orders. Placing stop-loss orders helps limit potential losses in case the market moves unfavorably. Manage position sizes. Risk only a small percentage, e.g., 1 to 2%, of the trading account per trade. Avoid overtrading. Excessive use of leverage increases exposure to losses. Trade only when there is a clear strategy. Gain experience first. Practice with a demo account before using leverage in real trading. Leverage is a powerful tool that can enhance trading profits, but also pose significant risks. Using it wisely with proper risk management ensures that traders avoid excessive losses and remain in the market for the long term.